Hi there, I am Ferdy. I want to explain the financial model that makes financial cooperatives so exciting to you. It is very important that you, and every member, understand the principles on which the financial cooperative is founded. This will ensure that everyone can make maximum use of the benefits in the cooperative and will make it possible for them to participate in member meetings. The best way to explain the financial concept of a financial cooperative is with an example. The example that will be used in this explanation is based on the following assumptions. 1. That the group is already 100 strong. 2. That every member agrees to save 100 Rand per month. 3. That every member will take a loan that will be repaid in 5 installments. 4. That no interest will be charged on loans and that no interest will be paid on savings. It is first important that you understand the flow of the capital in the cooperative before we will explain interest rates. It is best to immediately explain the assumptions in relation to the reality to you. Else, you may think that the assumptions are rules, which they are not. Let us take the size of the group for example. A financial cooperative starts with only a few members and can grow as big as it wants to. There are financial cooperatives in other countries that have millions of members. In the real situation, saving amounts is a personal decision by the members. Every member can decide how much they want to save. Some will save a lot more than 100 Rand per month. They can even decide to deposit only one amount. They will also be able to withdraw their savings. The term of a loan is based on the affordability of the loan for the member. Loans can be as short as 1 month and up to years for bigger loans. It depends on the policy of the loan product, as set by the directors of the cooperative. It is possible to get an interest for a loan in a financial cooperative. However, it does cost money to manage a loan over its lifetime. Therefore, administration fees are charged. The good news is that these fees, as calculated as a percentage, get smaller the bigger the loan gets. A small loan of less than 5,000 Rand may cost the member 10%, while a loan of 50,000 Rand will cost only 4%. In month 1, the group will deposit their savings in the cooperative. 100 members that save 100 Rand each will contribute 10,000 Rand. This money can immediately be used to grant loans. Let us say, for example, 4 loans of 2,500 each. Please note, the principle that is used here is that maximum use of the money is made by granting loans. There is no sense in letting the money lie in a bank account where none of the members will benefit from it. In month 2, the members will again contribute their savings, and again 10,000 Rand will be available. The 4 members that were granted loans in the first month must now also pay an installment on their loans. For a loan that must be paid back in 5 installments, the payments will be 500 Rand each. Another 2,000 Rand is then available, and together with the savings the cooperative can grant loans to the value of 12,000 Rand in month 2. Please note that the principle here is that the payments, which is possible because of the savings of month 1, can be used again. In a financial cooperative, the savings can be applied for loans more than once in a year. Let me explain how this process will play out if we do it for the whole year. In the left-hand column the months are displayed. Next to it is the savings column. The monthly savings of the members will be displayed in this column. The right-hand column displays the loans that can be granted to the members. In the middle, the installments on the loans as it is received will be displayed. In month 1, the savings of 10,000 Rand is received. It is then used to grant loans to some of the members. The payments on these loans will be paid back to the cooperative in 5 installments of 2,000 Rands each. In month 2, the savings of 10,000 Rand is received again, plus the installment of 2,000 Rand. There are thus 12,000 available for loans. The payments on these loans together will be 2,400 each month, for 5 months. In month 3, 2 payments are received together with the savings. There are then 14,400 available for loans. The borrowers will pay it back in 5 installments of 2,880 Rand. In month 4, the cooperative will receive 3 sets of payments with the savings. This will result in 5 payments of 3,456 Rand. In month 5, the income of savings and payments are 20,736 Rand. This will result in 5 payments of 4,147 Rand. In month 6, the amount available for loans will be 24,883 Rand. This will flow back to the cooperative in 5 payments of 4,026 Rand. In month 7, the amount available for loans is 27,859 Rand, and in month 8, already 31,031 Rand. In month 9, it increases to 34,358 Rand, and in month 10, 37,773 Rand. Some of the loans will only be repaid in full in the next financial year. This provides additional turnover potential for the second year. The amounts available for loans in months 11 and 12 are 40,181 Rand, and finally 44,411 Rand. If this process is summarized, it can be seen that the members saved 120,000 Rand together, but were able to grant loans of 315,000 Rand to each other. This relationship between savings and loans is called the accelerator factor. This process allows the cooperative to borrow more to its members than they have saved, placing very low-cost capital in the hands of the individual members that they can use to create wealth for them. In the previous slide it were mentioned that each member could borrow 3,159 Rand. Using this average loan size creates a problem in the cooperative. We refer to this problem as the potential bottleneck problem. By using the average method, member 1 could qualify for a loan of more than 3,000 Rand by contributing only 100 Rand. On the other hand, member number 100, who had to wait for 12 months for his loan, and who contributed 1,200 Rand in savings, will get the same size loan. Everybody wants to borrow in month 1, because it gives the best deal. The cooperative wants to grant loans in an orderly fashion through the whole of the year, but also wants to grant the loan as close as possible to the month in which the member plans to take up the loan opportunity. To facilitate this process, the cooperative will apply a fairness rule. Let us explain how this fairness rule will work in the next slide. The fairness rule is determined by calculating the optimal ratio between the savings of a member and the size of the loan. Let us carry over the optimal cash flow figures, as calculated in previous slides. By applying this ratio to someone that wants to borrow in month 1, a loan size of 550 Rand can be granted. With the 10,000 Rand available, 18 such small loans can be granted. If a member waits until month number 2, 2 savings amounts will have resulted in a balance of 200 Rand. This amount, multiplied by the ratio of 5.5, will result in a loan of 1,100 Rand. With the available 12,000 Rand, 10 loans can be granted. In month 3, the loans will be 1,650 Rand each, with 9 loans possible. In month 4, loan sizes of 2,200 can be achieved. This ratio will then remain the same for the financial period, and the savings balance will determine the potential size of the loan. This rule also accommodates the real-world fact that some members want to save more, and others less. The bigger the savings balance, the bigger the potential loan. Members can now save towards a target amount that they want to borrow. This makes it easier to fit members into the loan order, and also means that they can actively participate in the planning process. These calculations are based on the assumption that all the members want to borrow money during the year. In reality, however, it is only about 80% of members that want to borrow in a given year. About 20% just want to save. This means that there are usually surplus loan capital available in the cooperative. Some members will thus be able to borrow more than once a year. Another assumption of this calculations is that no interest is paid on savings, and that no interest is charged on loans. The benefit for members is thus in the low cost of the loans, and not in the earning of interest on savings. Because members can borrow more than they save, the benefit, seen in monetary value, is bigger on the loans than on the savings. For the savers, this creates a problem. They may withdraw their savings to invest it in other instruments that will give them a return on investment. In the cooperative, we want to discourage this. Therefore, the cooperative must give the savers the benefit of interest on savings. In the next slide, we will demonstrate how interest on savings is possible. To explain the calculation of interest on savings, the case of member number 100 will be used. This member saved 1,200 Rand during the year, and this qualifies the member for a loan of 6,600 Rand. If the member is not interested in taking this loan, it can be offered to someone else. Because this loan is not based on the savings contributions by the borrower, a fee can be charged for the opportunity to be granted the loan. If the board of the cooperative, for example, charges this borrower 5%, which is 330 Rand, and gives this to the saver, it means that the saver will get a return on investment of 25%. The board of the cooperative will decide on the rate to charge a borrower from time to time, according to the impact of market forces. It is not, however, so simple as that. The income on this loan will only be paid to the cooperative in the next financial year, and it cannot be guaranteed that all the money will be borrowed. Therefore, the board will offer the member a rate that is above average for the market, to attract savers, and will allocate a bonus to the members if more are earned. In a financial cooperative, the board must balance the return on investment demanded by the savers with the cost that the borrowers are willing to pay. A 5-month term for a loan will not be acceptable to every borrower. Therefore, the cooperative will have to be flexible when it comes to the terms of loans. To do this, the fairness ratio must be fine-tuned. The term of the loans have the biggest influence on the fairness ratio. If a member is willing to pay back his loan in 5 months, the cooperative can apply a fairness ratio of 5 times the borrower's savings. If the member prefers a 6-month term, the ratio that will be applied is 5 times the savings. A term of 7 months will lower it to 4.7 times the savings, and an 8-month term will result in 4.5. A 12-month loan will have a fairness ratio of 3.9. While a 24-month term will have a ratio of 3.4, or 36-month term will have a ratio of 2.98. The main legal requirement for a loan is that it should be affordable for the borrower. In the cooperative, the best affordable payment over the shortest possible term will be the ideal. In cooperatives, the terms of the loans will vary according to the individual needs of the members. New members will constantly join while others may resign. Worldwide, financial cooperatives standardize their operations by offering members 3 times their savings. This have the result that the shorter-term loans balance out with the longer-term loans in the cash flow of the cooperative. This process is repeated every year in the cooperative, with the difference that the savings of the members increases as they continue to save. This forecast shows that the group saved 120,000 Rand in year 1, but were able to grant loans of 315,000 Rand to each other. The average loan term were 5 months. If they continue to save during year 2, the savings pool will increase to 240,000 Rand, while the loans can be as much as 700,000 Rand. The average loan terms for this calculation would be 12 months. In year 3, the savings will increase to 360,000 Rand, while the loans granted can be as high as 1,080,000 Rand. This with an average loan term of 18 months. In year 4, the cooperative can grant loans to the value of 1,440,000 Rand, over a 24-month average loan term. In only 4 years, the total loans granted to members can be as much as 3.5 million Rand. Let's put this in perspective for a single member. Such a member that starts saving 100 Rand per month, and continue to save for 20 years, will be able to borrow $1.5 million from the cooperative if the 20 loans that can be taken are added to each other. This slideshow explained the financial process in a financial cooperative. From this cash flow process, various savings and loan products can be derived. In the most basic and powerful concept, interest for loans can be enjoyed by members. By adding interest in other policy decisions, a rich variety of tailor-made products can be designed to fit the needs of the members. Look at the different slideshows and movies that explain the other products and benefits in the cooperative, and discover the full power of a financial cooperative. All over the world, financial cooperatives are assisting its members to create wealth for themselves, leveraging their combined effort, money and knowledge in a highly moral democratic organization.